Is hedging with futures contracts an effective technique for commodities? In today's fast-paced financial world, many investors are asking, is hedging with futures contracts an effective technique for commodities? With recent market fluctuations, this topic has gained significant attention. Investors, producers, and consumers are all keen to understand how they can manage risks associated with commodity prices. Hedging with futures contracts is a common strategy in commodities investing. It serves as a risk management tool that helps individuals and businesses protect themselves against price changes. For instance, a farmer can sell futures contracts to secure a price for their crops before harvest. This way, they can avoid losses if prices drop later. On the other hand, a manufacturer might buy futures contracts to lock in a price for raw materials, ensuring they do not face higher costs in the future. The importance of futures contracts becomes especially clear in volatile markets. Natural gas, oil, and agricultural products often experience significant price swings. By using futures contracts, market participants can stabilize their cash flows and reduce uncertainty. This is particularly helpful during times of market instability, such as what we saw earlier this month with rising oil prices. Another advantage of using futures contracts is the transparency they provide. Market participants can see price movements in real time, which helps them make informed decisions. Additionally, cash-settled futures contracts linked to price indices help minimize the risk that the futures price and the spot price will not move together. However, it is essential to recognize that while hedging can reduce price risk, it may also limit potential profits. If the market moves favorably beyond the locked-in price, the hedger might miss out on those gains. Furthermore, futures markets can involve leverage, which means both potential returns and potential losses can be amplified. Investors must carefully consider their risk tolerance when using this strategy. In summary, hedging with futures contracts is a widely used and effective technique for managing commodity price risk. It offers a way to offset price volatility and improve supply chain stability. However, users should be aware of the limitations and trade-offs that come with this approach. As market conditions continue to change, understanding these strategies will be crucial for anyone involved in commodities investing.